Well, hello everyone, and welcome to Morningstar's 2025 Outlook webinar. Thank you so much for joining us. My name is Dan Kemp, and I'm the Chief Research and Investment Officer at Morningstar, and I'm joined today by a wonderful panel of experts to speak to you about the outlook for the year ahead. Now, we know that you are deluged by outlooks at this time of year. And so the obvious question is, why should you read ours? Well, we think ours is a little bit different because instead of trying to predict what's going to happen in the year ahead, which is what a lot of outlooks do, we've created our outlook as a tool to help you make good decisions about either your investments or your clients' investments in the year ahead. And so what we've done is taken the work of our 400 plus researchers and investors around the world and condensed that into 6 bite-sized sections designed to address a specific situation that we know is in the minds of investors at the moment, or a particular question that we keep getting asked by advisors and investors. And we're going to touch on 3 of those topics today. First of all, we're going to focus on finding returns in a falling interest rate environment. So that's looking at alternative strategies for navigating this low interest rate environment. Second, we're going to be looking at the pros and cons of investing in private assets. And then third, looking at the impact of AI on investing in 2025. And I'm delighted to be joined by 4 of the authors of those pieces here with us today. So first of all, we have Dominic Pappalardo. Dominic is our Chief Multi-Asset Strategist. He's based in Chicago, and he'll be talking about the fixed income investing environment. We have Brian Moriarty, who's a strategist in our US fixed income group within manager research in the US, and he'll be looking at private and public investments. Then we have Dave Sekera, who's our senior US market strategist, also based in Chicago. And finally, we have Danielle Labotka, who's a behavioral scientist in our behavioral insights team, also based in the US. So this is the panel that we have. We'll be talking to each of those in a moment, but we also are going to have lots of time for questions and answers. So please do ask questions as we go along. If you're on the Bright Talk stream, then you can do that in the Ask a Question tab, or if you're in LinkedIn, it's in the comment stream. We've reserved 15 minutes for questions at the end, but please do ask your questions as we go along to make sure that we address as many of those as we can. So just a couple of bits of housekeeping before we dive in. The first is check out the attachments tab. That will give you the link to the full report. So there's 6 topics we talked about that we're just going to be able to touch on a few of them today, and all of the related content as well. So do check that out. And second, don't forget to rate and review our webinar. We love to get your feedback and also your suggestions for what we can do better. So with the housekeeping done, let's dive in. So we're going to go first to Dominic. So Dominic, just by way of background, we know that the Fed has implemented the first interest rate cut since 2020 in September, followed by another 25 basis points cut in November. So what are the overarching implications of this regime change that we're seeing as we go forward?
Yes, Dan, great to see you today. The September rate cut signaled a regime change from the Fed. There's no doubt about it. From 2020 on, the Fed was in a hiking cycle, mainly to combat the post-pandemic inflation, which reached a level we hadn't seen in decades. The rather aggressive decision they made to cut by 50 basis points suggests the Fed has gotten quite comfortable that the downward trends in inflation are sustainable, and they can move towards easing the burden of that restrictive fiscal policy. Going forward, they may be shifting their focus to avoiding undue economic stress by keeping rates too high for too long. In other words, they really want to preserve the likelihood of achieving their desired soft landing that's been talked about so much. Recent economic data suggests the economy is still relatively strong compared to where we were in previous easing cycles. Unemployment still in the low 4% range, down a bit, higher a bit year over year, but certainly at a level that still signals full employment, and GDP is expanding at a rate of just about 3% at the end of 2024. Dan, it's noteworthy, though, that rate cut of 50 basis points in September is meaningful. 50 basis point moves have been quite rare in recent decades. The only reductions of this magnitude have been considered emergency cuts occurring during events such as the onset of COVID in March of 2020, and prior to that, all the way back to 2008 during the global financial crisis.
Fantastic. Thank you, Dominic. So, yes, that gives us an idea of the magnitude of this change that we've just gone through. And it's really important that investors are aware that we've had this change. So, with that now in the background, what should investors be expecting from the Fed going forward?
Yeah, hopefully everyone could see the graph displayed on their screen. We certainly believe the Fed will continue to reduce rates into 2025, which theoretically should push all local rates lower in conjunction with that. As you could see, the red bars trending downward are forecasts for what we expect to occur in by the end of 2025, Fed rates down closer to 3%, and the year following maybe as low as 2%. So pretty strong downward trend. However, the potential caveat to this view is a rebound in inflation or unforeseen increase in inflation. The Fed has proven their number one priority is controlling inflation, and if for some reason CPI data starts to move up, that could change this outlook dramatically. Especially long-term rates could move higher. However, in either scenario, the yield curve is likely to steepen. If the Fed continues to cut, that should have an outsized move on the short end of the curve, pushing those rates lower. And if inflation does rebound, we would expect longer rates to go higher. Again, either way, steepening the shape of the yield curve.
Yes, thank you for that. So I guess a message to investors as they think about the year ahead is don't get too focused on one particular path, one particular outcome. So although, like others, we are expecting rates to fall. That's just one of the possible outcomes. And when thinking about rates next year, we have to think probabilistically across a whole range of outcomes there that you mentioned. And so when we think about what investors should be doing, we know that they've been building very large cash positions over the last couple of years. Is that still the right thing to be doing as we head into 2025?
Yeah, Dan, in a word, no, we don't believe so. Hopefully everyone could see the money market flow trend on the screen right now. And it's been steady inflows into money markets since the pandemic. These have reached levels of somewhere in the neighborhood of $6.5 to $7 trillion in cash sitting on the sidelines, which is an all-time record. It certainly made sense to hoard this cash when the yield curve was meaningfully inverted, which allowed investors to earn a higher yield on cash as opposed to longer-term fixed income investments. But that's not necessarily the case today, and we certainly don't expect that to persist into 2025. Benefits of holding that outsized cash position fade quickly when rates are falling. Not only does the income generation potential erode, but by definition, cash cannot offer any price appreciation as rates decline, unlike longer-term bonds, which will see their prices increase as rates fall, which helps generate total return both through income and price appreciation. The move out of cash today requires less of a yield give up than at any point in 2022. As you can see on this chart, the yield differential amongst different maturity points is right around zero. So there's really no penalty to move out of cash today like there had been in the previous 2 years. However, this begs the question, where should you reallocate to? We believe the intermediate segment of the yield curve, say 5 to 7 year maturity range, maybe even the 10-year range, offers the most compelling risk-reward balance, as there's opportunity for price appreciation as rates decline without the larger drawdown risk of, say, 30-year bonds if rates unexpectedly rose for some reason.
Great, thank you. So that's also a really important message, that people have been building these cash piles, but we know that if people now move from cash into bonds, into fixed income, then there's less of a give up in terms of yield, which we know investors have been worried about over the last couple of years. There's less of a give up than there has been, but you may get that price appreciation if we continue to see those falling yields. So great. So that gives us a framework in which to think about cash and fixed income. But when when we look within fixed income, we know that's not just one market. It's not just treasury bonds. It's a whole range of markets. So are there particular asset classes that you favor in that market? You mentioned government bonds of sort of 5 to 7, maybe even 10 years maturity. And there's certain asset classes that you'd be concerned about as we're moving out of cash and into fixed income.
Yeah, it's a great point, Dan. Portfolio construction is always important along with asset selection. And if we look back at 2024, owning credit assets was a great decision. They dramatically outperformed government bonds, particularly in the US. But that also means the attractiveness of their valuations has diminished going into 2025. From a valuation perspective, the yield spread, meaning the additional yield an investor earns over and above a treasury, is historically low for both investment grade credit and high yield credit. And by credit, I'm referring to corporate bonds in the US. This creates a bit of a unique conundrum for investors because the all-in yield of these credit sectors can look very appealing, but the valuation component in terms of the spread is quite unappealing. Using high yield corporate bonds as an example, the all-in yield today is around 7.3%, which is in line with longer run historical averages and certainly is appealing on the surface. However, the spread component is only about 2.6%, which ranks all the way down in the fifth lowest percentile historically, meaning it's only been lower 5% of the time. So we do not believe there's sufficient margin of safety for investors to take on that below investment grade credit risk associated with high yield bonds right now, despite the lure of the all-in yield. Let's compare that with similarly rated bonds outside the US, looking at emerging market debt. In these markets, one lens we use to assess valuation is real yield, meaning that we look at the bond yield minus the local inflation rate. So for example, Brazil's 5-year bonds yield over 13%, Mexico's bonds yield over 10%, compared to local inflation rates in the mid-4s for those countries. So we would say on a risk-return trade-off, those emerging market bonds offer a much more appealing margin of safety than high-yield corporate bonds do in the United States.
That is fantastic. Thank you so much, Dominic. So just before we move on to Brian, we're already getting lots of questions. So thank you, everyone, for sending those questions in. We'll be addressing as many of those as we can as we go along. But I just want to ask one directly now to Dominic before we move on, which is how do you see the debt to GDP of the US impacting future market returns? And specifically, at what point is there a true inflection where debt becomes too strong a headwind? So I know this is in the mind of a lot of investors, which is why I want to make sure we caught this right up front.
Yeah, absolutely, Dan. It's a very legitimate concern. That would play out through increased yields, most likely, meaning that buyers of government bonds would require a higher yield to compensate them for the additional credit risk that more debt encompasses. Over time, we've seen fits and starts of this. We've seen treasury bonds get downgraded by different rating agencies, and really there hasn't been a meaningful impact to the cost of debt for the U.S. Obviously, we were at a extended period where rates were really near zero for a long period of time. So it's difficult to come up with a specific inflection point. I think investors look at this as a relative value or relative risk decision. So as long as the US is still considered, quote unquote, the safest amongst other global countries, they're going to have the benefit of lower borrowing costs despite their debt to GDP ratios. And frankly, it's anyone's guess what that inflection point would be. You know, we see other examples around the globe, like Japan, for example, where debt to GDP is far worse than it is in the US, and their rates are still under 1%. So there's a lot of moving parts that go into it. And unfortunately, I can't come up with a very specific number for that inflection point, but it is an ongoing concern and something that hopefully the US government is mindful of and doesn't allow it to get to the point where it becomes detrimental.
Yes, absolutely. And so important, that point about there's not a specific number, a specific inflection point. It often reflects a change in investor sentiment. And that means it's unpredictable, as you say. So we want to make sure that that debt to GDP is on a sure footing as it can be. But it's difficult to tell in advance when that can possibly change. But we've seen that example in Japan where it just grows and grows. Fantastic. Dominic, thank you so much. There was tons in there. And if you want to read more about how we're thinking about fixed income, then do dive into to the full Outlook document using that attachment tab. Right, we're going to shift gears now. We're going to go to Brian Moriarty. So, Brian, you've written tons about the convergence of private markets and public markets over the last year or so. I know it's been a key research topic for you, and we're seeing more broadly people gaining more access to private investments, which previously they wouldn't have been able to access. It would have been a small group of investors would be able to access that. So how is the convergence of public and private markets affecting the investment landscape in your view?
Sure. So there are two major effects that this is having, the second of which is downstream from the first. So first, it's kicked off a new wave of industry consolidation and partnerships. There's a long list of traditional asset managers that have been buying up firms that offer alternative or private asset capabilities. T. Rowe Price buying Oak Hill a few years ago is one example of this. And we've seen a few approaches of how these firms are going to market with these strategies. So for example, Capital Group and KKR announced a major partnership where in 2025, they will be launching 2 interval funds that will offer a mix of public and private credit. Then there's State Street and Apollo partnering to offer a private credit ETF. And then BlackRock and Partners Group coming together on a model portfolio solution. So those are 3 different go-to-market strategies: interval funds, ETFs, and model portfolios. And the jury is obviously still out on which of those will be successful, maybe all of them, maybe none of them. Now, I did say there were 2 effects, and the second is the impact of all this consolidation and competition. Asset managers are going to compete on offering better products, which give regular investors access to strategies and assets that they historically haven't had access to. With the right financial advice, that could be a real benefit. And as competition heats up, fees on these solutions will start to come down. That's a story we've seen play out many times over the years.
Yeah, so that really, again, important points there around the fact that there's no blanket response to this, that we can see some good things coming out of this as we see that access expanded. But obviously, people need to look out for fees. We expect them to come down, but there's few players at the moment. So a lot of the focus in the US, if we're going to get more specific, has been on private credit specifically. So why is it that private credit has really caught the imagination of investors and asset managers more than private equity at the moment?
Sure. So the short answer is that it's still more liquid than private equity or venture capital. In equity markets, the public-private line is very bright, and that line is very relevant for something like liquidity, the ability to trade and price these assets. In the debt markets, that line is blurrier. It's actually less of a line and more of a spectrum. And finally, most of the private credit market is floating rate, meaning the last couple of years of rising rates have benefited the private credit market relative to, say, the fixed rate corporate high yield market, which on a relative basis has underperformed the private credit market. Also, debt has a yield, right? It has a regular cash flow, which changes how they're used, how these assets are used in a portfolio. A percentage of that cash flow can also help managers handle redemptions. Debt also matures or amortizes in the case of structured credit. So on a given date, you know you will receive a specific amount of money. Private equity and venture, on the other hand, you're waiting for some liquidity event in the future, which may or may never come. So the cash flow, maturity, and potential tradability, even if it takes a few months, all make what we've been calling private credit, which is a very big umbrella that holds a lot of different assets, it makes private credit much more manageable to offer to investors, and one that will likely end up being easier for investors to own than trying to fit private equity or venture into, say, an interval fund.
Really interesting. So it sounds like it's just the sort of first steps that people are taking into private assets rather than necessarily having some long-term, say, return benefit over private equity. So that's important. So this is an evolving marketplace. So that's the upside. There's the kind of good things that we're seeing. Nothing good comes without risk. And so what are the risks that investors need to be aware of as these assets become more more accessible to the general public and to advisors?
So the risk is that private assets, it's very difficult to trade them. They're called private for a reason, and therefore it's difficult to price them. It's something essentially a Gordian knot in the private markets. So, for example, the net asset value of the funds that own these assets may not reflect the true or fair value of the underlying assets. There's going to be a disconnect between the two. And because they're hard to trade, investors may be unable to get their money out for a very long time. We've seen it happen where maybe a non-traded BDC gates redemptions, or in interval funds, the Wildenmuth Fund is a very prime example of this. It has been in liquidation, it gated and has been liquidating for over, I think, 2 years now at this point. It might have been 2 years in June, or at least 18 months, where investors have been waiting this long to get their money out. And so the liquidity is not a throwaway term. It is a very real risk when you offer these investments to investors who may not have experience owning them. A less dramatic risk, but I think one that might end up being more pernicious, is if these products don't meet expectations. So private credit especially promises to offer at least 1 or 2 percentage points of yield more than the public high yield market. And with all the competition, with all the money that has flown or flowed into private credit, private credit has raised more money in the last couple of years than they ever have. There is obviously the risk that return expectations come down because all the money chasing what is a limited pool of loans theoretically. So return expectations might not be met, especially relative to the last couple of years, which, like I mentioned before, with the rising rate environment and these being mostly floating rate, has been particularly good for private credit relative to the public fixed rate market. So return expectations might not be as good going forward as they have historically, at least the last couple of years. And especially when you factor in that investors are likely giving up some liquidity, especially if they're accessing these through an interval fund, a tender offer fund, a non-traded BDC. One of the questions that advisors and investors need to ask is what they're giving up worth what they're getting.
Yes, yeah, absolutely. And I would just add one point on that. Do they understand what it is that they're giving up? I think particularly with end investors maybe getting involved in private assets for the first time, that education piece that advisors do is so important. So again, we're having tons of questions coming in, so that's fantastic. I'm just going to pick out one to ask you before we move on, Brian, and that is, it's a very broad question, but the question is, what do we think about, well, I'll phrase it differently. What do you think about the companies that are offering these new investment funds, these new opportunities?
That is a broad question. I think the jury sort of remains to be out in the sense of some of these firms, if we take a traditional private manager, Apollo or Carlyle, that historically have not engaged with the quote unquote retail, the regular investors, that market. And so how they engage with that market will be different. They are going to have a learning curve on how to interact with firms like Morningstar, regular advisors and investors who are coming to them for the first time. And so it's going to be a learning curve on both sides, and how they engage with these new customers, I think, will be a differentiator. Also, they might not be used to competing on fees the same way that the traditional asset managers are. And I think a lot of these reasons are, or a lot of these factors are some of the reasons for why we've seen partnerships. I mentioned 3 of them earlier, for going to market in this way rather than firms trying to organically build or maybe bolt on buy these capabilities, because not both sides sort of they know what they lack, and so they have found ways to come together and offer these solutions to investors. But I think a big differentiator will be how these private or traditional, like alternative asset managers, engage with their new markets, their new customers, and if they're sort of ready for maybe the increased scrutiny that comes along with that.
That is tremendous. Brian, thank you so much. We're going to leave it there until we get to the main bulk of questions later on. But I just want to encourage folks to read Brian's piece in the Outlook. One of the things that we've done there, which we haven't covered in this brief section, is that we've looked at a great case study of where private assets have been used really well in that end investor space, and that's in the superannuation schemes in Australia. So if you're not familiar with Australian superannuation schemes, or even if you are, it's worth having a read of how that's played out in that market, which has been really instructive. So, Brian, thank you so much. We will come back to you doing questions, but now we're going to move on to Dave Sekera. And Dave, as I mentioned, is our senior US market strategist. And Dave, we've been talking about AI and AI investing for quite a few years now. So why does this topic earn a place in this year's Outlook again? What's likely to be different in 2025 from previous years?
Well, I'm expecting this is going to be the year where we really see the evolution of AI switch from, the hardware providers, into the people that are able to utilize AI in order to be able to generate additional revenue or additional, operating margin. So I think to some degree, in order to understand, where we're going, you also have to look at, where we've been. And when I look at AI, I think it really started in November of 2022 with the launch of ChatGPT. I think that really first started to capture the imagination of investors as far as what AI might actually be able to accomplish. So 2023 and this year in 2024 were the years that tech companies began really in earnest to build out their hardware and their software platforms to support that AI development. Over the past 2 years, there's just been, huge amounts of demand, more demand than the amount of supply, really for everything that's been needed to build these dedicated platforms. And of course, that drove prices, through the roof. Now, the old adage in investing is that, during the gold rush, it wasn't always the miners that got rich, but those that sold the picks and the shovels. And the past 2 years, the picks and shovels have been NVIDIA and those other hardware providers who have seen growth really unlike any other time that I've seen other than, the dot-com bubble. So when we look forward at projections, for certain items, for example, we highlighted accelerator sales. We see that while the rate of growth is still going to be high for the next couple of years, that rate of growth is now decelerating. I think we're now at the point where, those hardware suppliers have built out enough new capacity to be able to better address the amount of forecasted demand. So after spending as much money as they have, on AI hardware, I think investors are now looking at, the corporations out there that have spent that money, the corporations who are dedicating resources to really, how are they going to be able to utilize, all of that capex they've spent over the past 2 years in order to generate value. So in 2025, I really expect to see the number of use cases for AI begin to expand rapidly, and then also looking for, companies to really identify how they're going to drive, top line growth, and or expand their operating margins by using artificial intelligence.
Fantastic, thank you. So that really is quite a big change as we head into the new year, that we were focused, and people who read our 2024 Outlook a year ago will remember that in that piece there, Dave was highlighting, as he just did, the picks and shovels manufacturers. And now we're a year later, we've seen so much good news in the expectation of those companies that we're now seeing opportunities elsewhere. So that is a really big change. Now let's move on from there and think about how these companies are using AI, because those of you that are familiar with Morningstar Equity Research will know that we base a lot of what we do on the work of Warren Buffett, who you'll probably be familiar with. And Warren Buffett describes the quality of a business as being the size of its moat, whether it can protect its business from competitors. And so, Dave, as you look at this sector going forward, what are the companies that are able to dig a new moat or widen their moat and really build that competitive advantage through using AI as we look forward?
There's really two main ways that I'm looking for it right now. First is going to be on the top line with revenue. Which companies are going to be able to incorporate AI either into their existing platforms to build new services? How are they going to enhance, their intangible assets? That is one of the ways that they can either widen or dig a new moat. But I'm also looking for ways that companies, might be able to enhance or generate new products, which of course then could lead to, other moat sources such as switching costs or maybe increased network effect. And to some some degree, even maybe, efficient scale. And then secondly, looking for those companies, that are able to incorporate AI into their own business practices, those that can use that in order to generate, increased efficiency, where we can see operating margins start to expand. And that, of course, could drive the cost advantage, which is, the fifth moat source. But really, I'm expecting companies that are able to widen their economic moat to see an increase in their intrinsic valuation. Those that are able to generate returns on invested capital higher than their weighted average cost of capital, either for, longer time periods than what we currently expect, or for even greater returns, than previously projected. And of course, then you also have to watch out for those competitors that aren't able to keep up, those that find themselves at competitive disadvantages. Those are the ones that we would likely see erosion of their intrinsic value over time.
Fantastic. Thank you. Yes. So, as you said, they're building their intrinsic value. And I think in the outlook, you've highlighted some stocks, both the picks and shovels makers and also the use of AI that have different valuation outcomes based on whether people have really grasped the impact of AI or not. So, dig into the outlook, you'll see Dave's sort of picks and pans there in that piece. So, next question then, Dave, what are the key attributes that investors should be on the watch for to identify those companies that will lead the next step in the evolution of AI?
Yeah, it's just one of these things where with, any new technology, it's still pretty unclear exactly, how AI may be utilized, among a lot of different sectors, much less in individual companies. What we're seeing right now and hearing is that, just all the companies under coverage are really in the midst of developing their own use cases. We expect to see new use cases emerge, over the next couple of years. But for now, when I talk to our analysts, I know there's a couple of things that they're specifically listening for, when they talk to companies or listen to their earnings calls. First are for announcements and how AI is integrated into existing product lines. One good example there is at ServiceNow. They're incorporating AI into their professional plus tier. That, of course, then allows them to charge higher fees, but it also has the benefit of being able to retain those customers with that stronger product offering for longer. So again, you don't have to worry about those customers switching to other platforms. We're also listening for announcements for new product offerings based on AI. A good example there is going to be a Google AI overview. So when you do a Google search now, you'll see the first thing that pops up at the top of the results is going to be, that Google AI overview. I know that they've talked about that generates, additional clicks, additional usage, by their user base. And then lastly, looking for specific examples where companies can utilize AI to enhance their own efficiency. And so we know Walmart on one of their earnings calls, specifically highlighted how they were able to use AI to improve their product catalog, which otherwise would have required, I think, 100 times, their existing headcount to be able to do, the same thing. So really, in the spirit of leveraging off of, Peter Lynch, his, philosophy of investing in what in this article, we also highlighted, a number of different, use cases that financial advisors are able to use, in their own daily life, and then they can use, how they use AI themselves to be able to identify, in different sectors and different companies, how those companies, would be able to benefit off of AI and help drive intrinsic valuation over time as well.
Yes, fantastic. Thank you, Dave. You've now completed our investment webinar bingo card in that we've got Warren Buffett and Peter Lynch both in the same webinar. So we've done our job there. Now, before we move on, there's two questions that have come in, and again, thanks for all the questions. Keep them coming in. We'll have plenty of time. But there's been two questions that are really on the same topic. So I'm just going to use one of them, which is, can you speak to the power requirements, the electrical power requirements of AI and how that may limit growth? How will the leaders in the category capitalize or be limited by these requirements? And an extension of that, how can companies address their water use? Now, that's a very specific question, that latter one, but I'm sure that the team have been thinking about the power use for AI companies.
Yeah, and one of the real big themes, in the market this year has just been the utility sector. Utility sector has really just skyrocketed. A sector you typically don't expect to see, the same kind of returns that we've seen, over 30% this year. I think they're up, 40 or even 50% from their bottom, last October. So definitely investors are paying attention to the power requirements. AI, of course, requires multiple times more power, in order to be able to, run that software as compared to, traditional. So we are seeing that, play out in the marketplace. At this point in time, I know that there are, a lot of new developments going on within the utility sector in order to be able to build out that new power. So our team, is looking for that to be able to meet the amount of demand that we're expecting at least over the next couple of years.
Excellent. Thank you very much. Yes, it's going to be a key question as we roll forward. And who would have thought those boring old utilities companies will have done so well? But I know that that's been a key focus of our analysts over the last year. So, Dave, thank you so much. We'll obviously come back to you doing the question session. So, the last session before we move to questions now, I'd like to welcome Danielle Labotka. As I mentioned up front, Danielle's a behavioral scientist in our wonderful behavioral insights team. And Danielle was a contributor to the AI piece that she co-wrote with Dave. And one of the reasons that we brought together our behavioral insights team and our equity research team to look at this topic is because sometimes it can be a little bit hard to imagine how a business can use AI. We see it in chatbots on websites and things like that. But in terms of some of the benefits that Dave was talking about there in the real core of what a business does and how they can improve their productivity, sometimes a little bit difficult to imagine that. Now, Danielle's done a lot of research recently on how advisors can use AI. And so we thought we'd bring that work into this to help financial advisors out there and also their clients really understand how advisors can use that AI. So, Danielle, over to you. Can you provide an illustration of what this looked like in the real world?
Of course. So one of the questions that, I think is very important to ask is why are we thinking that Gen AI is something that's going to be incorporated into financial advising successfully, right? It's not just something that we do for fun. It's something that we do because it's going to improve the sector in some capacity. And so we see financial advising as being able to win from generative AI because it's going to give advisors the opportunity to win back valuable time that they can spend face-to-face with clients. One of the things that we see a lot from advisors right now is that they're finding it harder and harder to differentiate, not just from other advisors, but also from new tools and technology that people can have access to that may do some of the traditional financial services typically associated with advisors. So we think that increasing those face-to-face hours with clients can really help spur growth for financial advisors. And so we're hoping that in talking about this, you can start to see not just how you might be able to use this in your own practice, but also, again, what kinds of factors other industries are going to have to consider when starting to implement Gen AI. So let's talk about what this actually looks like. I think that there are a couple things that are going to be common among advisors who are successful in implementing generative AI in their practice. The first is obviously just keeping an open mind to places where generative AI may help them buy back time to spend with their clients, right? We all know that advisors are pressed for time, partly because they have to wear so many different hats. They're not just talking to clients, they're also doing a lot of things behind the scenes, like portfolio construction and compliance and marketing, right? And these are very important. They are valuable, but advising at the end of the day really is a relationship business. So advisors are best able to provide value to clients when they're working with them face to face. And because of that, finding those opportunities to save time with AI is going to be valuable to leverage it for growth. But the second thing that advisors need to do is to hone their ability to recognize what are actual good uses for AI and what are not. And this happens on a couple of levels. The first is just understanding what the technology actually does and what it's good for. AI is really good at doing things like summarizing material for people or drafting text, but it's not so good at other things that are also really important in financial advising, like critical thinking or taking the human perspective. And so you want to know what it can do and what it can't do well But you also want to know what your clients are okay with and what they're not okay with. Because if we're seeing Gen AI as an opportunity to build better relationships with your clients, you want to make sure that you're not harming the relationship in the process. So people might be kind of wondering, like, why would we be worried about that happening in the first place? Why would we think that Gen AI might be a problem to the relationship? And the thing is that we know from previous research that people have this thing called algorithm aversion, where we tend to be resistant to technology like AI or other algorithms making decisions for us or trying to, do human type things. And so we did some work here at Morningstar to look at what people were okay with in terms of use cases for AI and financial advising. And the good news is that there are some things that people were like, this is great. I think that I'm totally fine with this. They thought that advisors using Gen AI to create educational materials or marketing materials was a perfectly acceptable use of the technology. However, they weren't a big fan of everything. So, in particular, when we were looking at use cases where AI was being used to personalize something to the individual, we saw that people thought that it would have a negative impact on their relationship with their advisor. So, in short, people were sensitive to AI being used by advisors as a shortcut to sincerity. And so this included things like, using Gen AI to help create personalized recommendations for people based on their behaviors and based on their accounts. But it also included things like writing personalized emails for your client to congratulate them on a milestone. And I think that this is where we have to introduce the idea of nuance, which I know always makes me a very popular person to do. Um, but what we want to say is like, okay, well, am I not supposed to use Gen AI for email creation at all then? And I don't think that that's the case. And in fact, I think it's a very common way that businesses are expecting to be able to kind of win back time using Gen AI. But it's about making sure that it's the appropriate context for the email. For example, if you use Gen AI to create emails to help with scheduling or reminders, or maybe even a generic newsletter, it's probably fine. It's probably something that your clients expect. But if you're doing something like using Gen AI to write a personalized bereavement email to a client who just lost their spouse or their parent, that's probably not a good situation to use it in. So in general, we see it's important to understand the effects of deploying Gen AI in different circumstances because failing to do so may end up being counterproductive to why you're introducing it in the first place.
Wonderful. Thank you. So, yes, you will have made so many friends among advisors talking about ways that they could spend more time with their clients. I know that is the favorite activity of advisors and the favorite activity of their clients as well, spending time with their advisor or advisors spending time with their clients and not with all of these other things that they have to do. And so the opportunity to use AI to help them do that within the constraints you outlined is so valuable. And just you talked about that previous research that you did. Now, Danielle, all of that research is available to advisors through our website and different formats. So do go and grab Danielle's research on how advisors can use AI, but also research on the deep relationship between advisor and trust as well. So a wonderful treasure trove of research there available to people. Now, just so one last question to you before we move on. In summary, how should advisors deploy AI? We hear in technology world a lot about moving fast and breaking things. Is that the approach that an advisor should take, or should it be a bit more temperate in the way that they approach using AI for the first time?
Yeah, I may have given away a little bit of how I think about it, but given the possible disruption to the relationship with the client, I do think advisors will want to be thoughtful and strategic about how they use Gen AI in their practice. I think anytime we get like a new technology that's pretty cool and really easy to use and kind of fun, it can be really tempting to throw that tool at as many problems as possible and see what sticks. But I think doing so can neglect how your clients feel about the technology when it comes to, financial advising. We want to think about how end clients feel about Gen AI because we know people have a lot of concerns about AI and in general. And when it comes to financial advising in particular, people may be even more sensitive because how important and personal growing their wealth is. We found that people were concerned about a number of things when it came to Gen AI and financial advising, like their data and privacy, how transparent their advisor was about it, how much human oversight the AI had, among other things. And so advisors looking to deploy AI should do so with these concerns in mind so that they can address them. So you want to build out your structure for using AI in a way that is sensitive to these concerns. For example, advisors can help address concerns about data and privacy by ensuring that they're using licensed versions of a tool. So they have clear ideas on how client data is protected and how it's used. But you don't want to maybe just stop there. Another thing you can do is maybe limit how much direct client information is accessed by a Gen AI. What does it actually need to do the job for you that you want it to do? Or you might consider limiting how many tools you use, right? How many tools have access to client data? And so I think that, sometimes it can be very easy when we know that a concern is maybe overblown to want to dismiss it. And I want to caution against that. So I had somebody come to me and say that the people worrying about their data with generative AI is like taking a dropper and putting a drop of water in the ocean and expecting to be able to find it in the future, right? So their point being that it's maybe an overblown concern. Maybe people don't really understand what's going on. However, I want to caution against that way of thinking. I think it's important to remember that perception oftentimes is reality. So if your clients are worried about something, then it needs to be addressed, even if it doesn't seem like a problem to you. And if it goes unaddressed, well, then that can damage the trust you have with your clients. And so I think a big misstep that advisors can make in deploying AI is assuming that they are on the same page with their clients about these issues. Instead, you want to ensure you have a comprehensive plan that addresses a lot of the issues that people might have and that you know how to communicate that with your clients. This gives you a chance actually to build trust as you bring it into new technology, and it can help you avoid some of the pitfalls. So just keep in mind when it comes to Gen AI that successful strategies not only account for the reality of the tool and what it can do, but also the perceptions of the people who interact with it.
That is fantastic. Thank you. And we've already got a lot of questions coming in, I believe from advisors, thinking about how they can use AI in their practice. So we'll get to as many of those as we can over the course of the next 30 minutes. But now I want to bring all of our great panelists back on, and we'll go through as many of your questions as we can. We probably won't hit all of them, but we will go through as many. And to our panelists, think of this as a quick fire round. Let's try and get through as many as we can. So first of all, Dominic, one to you. Why the weird disconnect in the Fed funds rate cut by 50 basis points and the 10-year yields increasing by 60 basis points? What is the 10-year yield outlook for 25? You've touched on that, but give us a bit more detail.
Yeah, no doubt, Dan. That was, let's call it an unexpected market reaction to a rate cut to see rates rise substantially in the month following. I think part of it really was based on the U.S. presidential election. And as it was becoming more clear that the Republicans had a chance to basically take control more broadly, that brought back some of those inflation concerns that we talked about in the opening section. And well, I'm not sure that inflation will materialize. It is a fact that some of the policies that the Republicans have campaigned on could be deemed inflationary. And of course, there's much nuance to that and timing. But I do believe the market thought a Republican victory was more likely to maintain inflation or push it higher than had the Democrats won.
Really interesting. Great. Thank you. Now, moving on to Brian. Great question here about private credit, Brian. So the question mentioned that you mentioned the risk of private credit not meeting expectations because of the demand side as a driver. But what about the supply side? If there's an increase in demand, my concern is private lenders lower credit standards to drive, the question is concerned, drive credit standards to drive more supply. What are your thoughts on that?
I think it's a very real risk. It's one that we have seen play out in credit markets. I think in every credit market in history, right? A prime example of that would have been the mortgage crisis going into '08. That's exactly what happened. Lenders lowered standards to lend more because there was demand. And so if there is demand, Wall Street will typically find a way to create the supply to meet that demand. So I think that's a very real risk going forward. I think what we'll end up seeing is perhaps a tiering effect of private credit managers, private credit assets and funds, where managers who have been a bit more selective, maybe that has hurt returns more recently, but over the long term, especially if we see default rides and sort of a washout, which happens every time a market grows and then right sizes, there will be a tiering or a differentiation between managers who have been selective and those who have not been.
Excellent. Brian, thank you very much. Now, obviously, we've had Dave talking about AI investing in particular, but Dave is our senior US market strategist, and we've got plenty of questions about the US equity market in general. So I'm gonna push these questions to Dave, and we're going to start with a really interesting one here. Historically, the stock market is overvalued. The question means the US market, I think. Sentiment indicators at historically high bullish levels. At some point, a correction or bear market will begin. First year of an election cycle has often been a down year. How do I hedge against this short of just raising a large allocation to cash? Dave, over to you.
Well, actually, I think that almost goes right back to you, Dan. In your earlier, comments at the beginning, you talked about how you have to be able to structure your portfolio, to be able to withstand lots of different outcomes, within the marketplace. Yes, valuations, are certainly getting stretched in a lot of different measures. We still see a number of different opportunities in the marketplace today that we still see to be attractive, that we think, are probably good places to overweight. And yes, there will be a correction. There will be a bear market at some point in time. Trying to call when that is, can sometimes be anyone's guess. At this point, when I look at the market, macro dynamics, they're still pretty positive, at this point in time. So really, I think it comes down to much more, positioning one portfolio, looking for those areas of the market that we think are undervalued today and are much more attractive on a risk reward basis, and underweighting or steering clear of those areas that look like you're just not getting paid for the risk out there today.
Excellent, thank you. And I'm going to do a quick follow-up as well as we're thinking about US equities. So question here that leads on from AI and the power consumption, which we talked about earlier. But given AI, Bitcoin, and electric vehicles, as the question says, are electric utilities a good place to invest in 2025 as we look forward?
Not in our view. When I look at the utility sector and I compare where the valuations are compared to, what our team, thinks these stocks are worth, we think utilities have probably run a little too far, too fast. It's actually a very interesting sector where you can see how market sentiment, can really shift. Oftentimes the market can act like a pendulum, can swing from, being very bearish and very undervalued all the way to, being, too bullish and then overvalued. And I think that's exactly what we've seen in the utility sector. A year ago, when we looked at utilities, they had sold off just because interest rates were rising. Of course, a lot of people use utilities as a fixed income proxy. Our analyst, Travis Miller, was out there just talking about that he thought the fundamentals and the outlook for utilities were as good as he'd ever seen it, over the past decade, yet the stocks were going down. They got to some of the lowest valuation levels as compared to our metrics, over time. And then this year, once people kind of caught on to the story, we now think the pendulum has not only moved, to the point where they're fairly valued, but probably moving to the point where we think that they're overvalued today. So it'd be one of those areas where I would look for other areas in the market that we see better valuation for long-term investors.
That explains why Travis was wandering around the office with a big smile on his face for quite a lot of this year. Yes, brilliant. Thank you. Okay, moving over to Dominic now. Fascinating question here. Is there a mathematical or technical reason why negative yield curve does not portend recession in 25 or 26?
Yeah, Dan, this is a much debated historical conversation where basically every recession that we've experienced in the US has been preceded by an inverted yield curve. However, the opposite is not true. There's been far more inverted yield curve instances than there have been recessions. I forget the stats, but something like the yield curve has predicted 8 of the last 6 recessions or something, an attempt at humor like that. Really, it comes down to does the market lead the rate move or does the Fed lead the rate move? And what we've seen now is the Fed is very close to executing the the soft landing scenario. And that means, in my view, that the market got ahead of what the Fed was actually required to do. And that's why we see the curve uninverting, which was part of the reason for the suggestion that investors move out of cash into longer term fixed income. So there is some truth to it that recessions are preceded by inverted yield curves, but an inverted yield curve does not necessarily guarantee there'll be a recession.
Excellent. Thank you. Yes, important there, that deterministic thinking that this must lead to that is so often a trap for investors. So thanks for unpacking that for us. Right, Brian, a deep question for you here. But can you please comment on the ethical issue regarding private credit in an ETF wrapper? With Dominic's comments on the poor valuation in US high yield currently, these assets are showing up in ETFs so the portfolio managers can access retail liquidity. But are retail investors well suited or positioned to understand the potential risks of these private assets?
That's a great question. It's an excellent question, and it's one that we're grappling with. I think broadly, investors need to have the right expectations when it comes to accessing these investments. Meaning, do they understand how the fees work, how hard or easy it is to withdraw your money? In the case of an ETF, theoretically very easy, and the exact role it's playing in a portfolio. These assets, but the underlying loans themselves these are leveraged assets, and sometimes the funds themselves might be levered, and they're also illiquid. So combining leverage and illiquidity, it's typically not the kind of investment to YOLO your money into, which seems to be the trend in ETFs these days. I think the bigger ethical question is going to be around how these assets, I mentioned the Gordian knot earlier, how these assets are priced and traded within the ETF wrapper. And that raises a lot of questions on arm's length pricing and how close or far the asset managers are to trading and providing these assets. And so I think that's a major ethical issue that has not been solved yet. I think the SEC's response to the Apollo State Street ETF will be a major signal if we see more of these or less of them. And like I said earlier, we expect theoretically a response with maybe by the end of the year. They recently filed an extension. December 20th is the end date on that extension. So we may know by December 20th, which might be a nice Christmas surprise or disappointment, depending on which side you fall on.
Brian, fantastic. I know the Apollo and State Street tie-up is quite complex, but in about 90 seconds, could you help unpack that for the audience in case they're not up to speed with that planned new fund?
Yes. So State Street is the advisor and the manager of the fund. Apollo has agreed to provide the private credit assets to the State Street fund. So Apollo is not an advisor or sub-advisor. There's appears to be no direct relationship or financial arrangement between the two in the filing, at least. The interesting thing is effectively the way Apollo has decided to solve the Gordian knot is literally the way Alexander did it with a swing of their sword, and promised to buy back the private credit assets that they have provided to the ETF. They promised to buy them back at the price that Apollo is providing. So Apollo is providing the price, and Apollo promising to buy them from State Street if State Street needs to sell them at the price Apollo itself has provided. And this is where we get into the ethical issues. If approved, it also is a very powerful mechanism, essentially, or arrangement to very efficiently move private credit assets in and out of the wrapper. The problem is that typically, Apollo is sourcing these assets, it's pricing them, it's selling them, and it's buying them. Typically, those four functions are all different in a normal market or a normal fund. Here they are the same firm, and that's where a lot of these issues arise from.
My word, you did well to explain that. Thank you so much. And classics and AI in the same webinar. We are nothing if not wide-ranging. Right, we are running up closely against time. But Danielle, I've got a question for you I want to make sure that we catch, which is what in the future might help clients be more comfortable in how an advisor uses AI to assist them in making investment decisions that are customizable to their life, season, and goals?
Right. I think that a huge thing is really that transparency piece. A lot of what advisors do already is a black box to their clients. And if you're putting a black box on top of the black box, right? It starts to get a little iffy in terms of like, am I really comfortable with what's happening to my money here? And so this is part of the big process that advisors, I think, need to do in general, which is to pull back the curtain and make it clear to clients, where the advisor is in the loop. So oftentimes with AI, they talk about having a human in the loop. An advisor should be in the loop here, right? This is the human oversight that's going to help ensure that, that the advice that they're getting is not biased by the AI, that it is well informed based on what the client's goals are and where they are, like you said, in the season of life and everything like that. And so the client needs to understand how advisors are still part of the process and taking into account the financial expertise that is needed to do investing well as the personal expertise about the client.
Brilliant. Thank you. We are over time, but there was just so many good questions. I want to make sure that we hit as many as we could. So it just leaves me to thank our wonderful panel today for all of their insights, to thank you, the audience, for spending this time with us. We hope you found it useful. Can I encourage you to go and download the Outlook and catch all of the other insights there. We've had questions about whether we have educational content on some of these assets. We've got tons on Morningstar.com or the other regional websites around the world, or on our research page as well. So do check those out and check out what these wonderful researchers have already written on. And with that, I will wish you all a good afternoon. Thanks very much. Bye-bye.